Welcome everyone to today's presentation on smart tax strategies. My name is Baptiste Brunner. I'm one of the financial consultants with Alliant Retirement and Investment Services, and we're confident that you will benefit from the information we're providing today, and I look forward to getting to know you and answering any questions you may have. I must also point out that there's no perfect tax management strategy, and every choice has benefits and limitations, and no single approach is right for everyone. Because here at Alliant Retirement Investment Services, we don't believe in cookie cutters or one size fits all strategies. But in this presentation, we'll provide important information about 8 key topics regarding taxes. Client Retirement and Investment Services, we're focused on helping you understand the ins and outs of investing, saving for retirement, and much more. And feel free to take a photo of this slide, but take a look at our website. That's ARIS, A-R-I-S, .AlliantCreditUnion.com to check out our list of webinars that we offer weekly. We also have our podcast and our blog, but go ahead and check out our website. Again, that's ARIS.AlliantCreditUnion.com. And aside from just banking here at Alliant Credit Union, we offer much more than that. So we're here to help you with your retirement planning, with investing, or just help you weather through certain life events, whether it be the death of a loved one, a job layoff, dealing with an inheritance, a new child is born, and then, of course, generational planning. And many of you are aware of this, but the One Big Beautiful Bill Act was passed on the 4th of July last year, and with it came many revisions to the current tax code. Though we don't have time today to dive into all of the specific changes, we think it's important to familiarize you with some of the more notable changes. And keep in mind that while some of these changes are permanent, others are slated to expire in the not too distant future. And we would encourage you to speak with your tax, legal, financial, and accounting professionals to see if there are any changes that you should be preparing for. Also, we have additional information in our offices that I'm happy to pass along that may answer some of your general questions about the new tax rules. And first, the standard deduction has been increased to $15,750 for single filers and $31,500 for joint filers. And that's starting for the 2025 tax year. And the state and local tax deduction has been temporarily increased from $10,000 to $40,000 for the 2025 through the 2029 tax years. Also, seniors aged 65 and older already enjoyed a $1,600 deduction. Now they'll receive an additional $6,000 deduction, or $12,000 for those who are joint filing, but this lasts up until the end of 2028 for a total of $7,600 in additional deductions for those filing individually. And the estate and gift tax exemption, which was previously slated to expire, has been now made permanent. The new $15 million cap for single and its $30 million cap for those filing jointly begins in 2026. And non-itemizers will receive a new charitable deduction of $1,000 for single filers and $2,000 for joint filers starting in 2026. There are a few more notable changes to cover under the 2025 tax law related to families and children to pass along. The non-refundable portion of the child tax deduction increased from $2,000 to $2,200, and the refundable portion remains at $1,700. Parents of children born between 2025 and 2028, they can now set up a savings account for their children with a $1,000 credit from the federal government, and it has a $5,000 a year maximum contribution limit. And the account functions similar to that of a retirement account. So the limit for the Dependent Care Assistance Program, which allows employers to provide dependent care assistance funds to eligible employees, that's increased from $5,000 to $7,500 starting this past tax year. And while this is by no means a comprehensive list of changes made by the new tax bill, I hope this gives you a general overview of some of the changes. Now we're going to discuss 8 specific tax issues. First, we're going to recap some key tax rules, then cover Roth conversions, afterwards healthcare laws and your taxes, some distribution actions that you can take, tax smart asset location, gift tax exclusions, treasury securities and tax exempt municipals, and then finally giving appreciated assets to charity. So we have a lot to cover, and we're going to keep this presentation moving. We'll start by doing a quick recap of key tax rules to bring everyone up to date. And there are a few new tax law changes for 2025 that you should be aware of. And these changes include starting in January 1st of last year, investors aged 60 through 63 can make catch-up contributions of up to $11,250 annually to workplace retirement plans. And the catch-up amount for people age 50 and older in 2025 is $7,500. Also, beginning in 2025, the Act requires employers to enroll employees in workplace plans automatically. However, employees can still choose to opt out. In this chart, we focus on long-term capital gains. And the highest earning taxpayers pay a 20% tax rate on long-term capital gains. Those in lower brackets will pay either 15 or 0%, just depending on their incomes. Just note that these tax rates do not include any applicable state taxes. And as a reminder, you have to hold onto a security for at least 12 months to qualify for a long-term capital gain treatment. While short-term capital gains, those are appreciated assets that are held for less than a year, those are taxed at your ordinary income tax rate. And one side note before we leave this image, ordinary dividends are treated as ordinary income, and qualified dividends are subject to the same 0, 15, or 20% tax rate that applies to long-term capital gains. Just keep in mind that this guide is for informational purposes only and is not a replacement for real-life advice. So be sure to consult your tax, legal, and accounting professionals before modifying your tax strategy. And one way to manage investment-related taxes is to consider taking advantage of a tax-deferred account, such as a 401k, IRA, 403b, an annuity, or even a health savings account. And these types of accounts have potential for tax-deferred growth. And you may also be able to manage your tax liabilities by revisiting your asset allocation strategy and shifting your investments to assets that generate tax-exempt income. For example, municipal bonds. They're often exempt from federal tax. And a municipal bond may also be free of state and local income taxes for investors who live in the area where the bond was issued. But if a bondholder purchases shares of a municipal bond fund that invests in bonds from other states, bondholder may have to pay income taxes. Also, remember that municipal bonds may be subject to the alternative minimum tax. And it's important to remember that an investment strategy should reflect your goals, your risk tolerance, and timeline. So as important as taxes are, they should only be one factor to consider when creating your entire investment strategy. Now, we mentioned a couple specific products as we introduced the topic of managing investment-related income, and here's some additional information to keep in mind when considering these choices. Municipal bonds are subject to a variety of risks, including interest rate adjustments, call risk, market conditions, and default risk. When interest rates rise, bond prices generally fall. Certain municipal bonds may be difficult to sell, and a municipal bond issuer may be unable to make interest or principal payments, which can cause the issuer to default on the bond. And if this occurs, the municipal bond may have little or no value at all. In most circumstances, two, you must begin taking what's known as a required minimum distribution from your pre-tax 401k or traditional IRA or other employer-sponsored retirement plan in the year that you turn 73 or 75. It just depends on when year you were born. But withdrawals are taxed as ordinary income, and if taken before age 59 and a half, they might be subject to a 10% federal income tax penalty. And the guarantees of an annuity contract depend on the issuing company's claims paying ability. Annuities have contract limitations, fees, charges, including account and administrative fees, underlying investment management fees, mortality and expense fees, and charges for optional benefits. Most annuities also have surrender fees, which are usually highest if you take out money during its earlier or its initial years of the contract. And withdrawals and income payments are taxed as ordinary income. And if a withdrawal is made prior to age 59 and a half, same thing. 10% early withdrawal penalty might apply. Now, if you're under 65 and you spend more money from your health savings account on non-qualified expenses, you will have to pay ordinary income tax on your withdrawals plus a 20% penalty. Also, after age 65, qualified withdrawals for medical bills are not taxed, and non-qualified withdrawals are treated like income and may be subject to tax. And let's take a deeper look into 401ks and traditional IRAs. Regular contribution limits went up slightly this year for 401ks, but there was no change in catch-up contribution limits. So taxpayers may now contribute up to $23,500 to 401ks, 403bs, most 457 plans, and federal thrift savings plans in 2025. The catch-up contribution limit for employees aged 50 years or older remains at $7,500. And beginning in 2025, people between the ages of 60 and 63 can make additional catch-up contributions of up to $11,250. And the limit on IRA contributions remains at $7,000 for 2025. Individuals aged 50 years or older can continue to make catch-up contributions of an additional $1,000. As you consider your choices, just remember what we discussed a couple images ago. In most circumstances, you must begin taking required minimum distributions from your 401k plan, traditional IRA, or your other employer-sponsored retirement plan in the year that you turn 73. Remember, withdrawals are then taxed as ordinary income, and if you take them before 59 and a half, you can be subject to that 10% federal income tax penalty. Also, contributions to a traditional IRA may be fully or partially deductible. It depends on your individual circumstance. Now, we will see slight changes to IRA deduction limits and Roth IRA cutoffs. The tax deduction for a traditional IRA contribution phase out varies just depending on filing status and workplace retirement plan coverage. Single with a workplace retirement plan, $79,000 to $89,000. That's an increase of $2,000 on both ends of this range. Married filing jointly and the IRA contributor has a workplace retirement plan that's $126,000 to $146,000. Married filing jointly and the IRA contributor does not have a workplace retirement plan, but their spouse does. It's $236,000 to $246,000. That's an increase in the prior range of $230,000 to $240,000. The adjusted gross income phase out ranges for Roth IRAs that rose last year in 2025. And single and head of household increased to from $150,000 to $165,000. Married filing jointly increased $236,000 to $246,000. But converting from a traditional IRA to a Roth IRA, it offers tax-free withdrawals on taxable contributions. So to qualify for tax-free withdrawals or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half, or due to death, disability, or a first-time home purchase, which is $10,000 lifetime maximum on your first-time home purchase. It's depending on state law, Roth IRA distributions can be subject to state taxes, so be sure to consider those as well. So far, we've covered some of the highlights of the current tax law. Now let's move on to talk about Roth conversions. And while Roth conversions are not right for everyone, they do provide advantages for some investors. In a Roth conversion, you may withdraw money from a traditional IRA to pay the federal and state taxes, if necessary, that are due, and move the funds into a Roth IRA, where all future growth and withdrawals are then tax-free. And Roths also don't have that worry that you would with pre-tax accounts of required minimum distributions, which makes it a very great tool where it can play a role in an estate planning strategy. Just one important detail to note is that you cannot undo a Roth conversion. If that's something you want to discuss, please just take a quick note and we can circle up after the presentation. Just remember, converting from a traditional IRA to a Roth IRA offers tax-free withdrawals on taxable contributions. On to our third point, healthcare laws and your taxes. So let's talk about how they may affect your taxes this year. There are 2 additional taxes that may affect high-income taxpayers. First is the additional Medicare tax, and the next one is the net investment income tax. And let's go ahead and start with the additional Medicare tax. So as of 2013, high-wage individuals pay an additional 0.9%, 0.9% on wages above a certain threshold. And who's subject to the additional tax? Well, if you're married and file federal taxes jointly, you're subject to a 2.35% tax on your combined wages that exceed $250,000 as compared to the 1.45% tax you pay on wages below that threshold. If you're married but file a separate return, the additional tax applies to wages that exceed $125K. For everyone else, the threshold is $200,000 of wages. Let's take a look at an example. A single individual in 2024 with wages of $240,000 would owe tax at a rate of 1.45% on the first $200,000 of wages and 2.35% on the remaining $40,000 of wages for the year. And the second Medicare tax affects investment income, also known as unearned income. And before 2013, you didn't have to pay Medicare tax on investment income. And with the net investment income tax, however, certain high-earning investors must pay an additional 3.8% tax on income received through investments. So people who must pay this tax include individuals whose modified adjusted gross income is above $200,000, people who are married filing separately with an adjusted gross income above $125,000, and couples filing jointly with an AGI of more than $250K. Some estates and trusts are also subject to this tax. And this tax applies to many types of investment income, including dividends, capital gains, rents, royalties, non-qualified annuity income, and any business income considered a passive activity. The tax does not include retirement plan withdrawals, Social Security benefits, and several other types of income. The particulars are complex, so we recommend that you consult a tax professional who can help you understand the rules. And these threshold amounts haven't been indexed for inflation, meaning they haven't changed since 2013. Therefore, they potentially affect more taxpayers each and every year. If you spend a relatively large amount of money on health-related services, you may be able to deduct those expenses from your taxes. And for 2025, you can deduct medical, dental, and other healthcare expenses that exceed 7.5% of your adjusted gross income. That's the same as it was in 2024. But these expenses include those associated with diagnosing, treating, or preventing diseases such as prescription drugs, some insurance premiums, medical equipment, and even travel for appointments. Just remember, you may not be able to deduct reimbursed expenses. We're going to look at some details that you should consider when taking retirement distributions. A way to help keep more of your hard-earned money is to think about how taxes may affect your income strategy. Here are some ways to avoid potential tax pitfalls when taking distributions. First, inventory all potential sources of retirement income. This list might include all of your retirement accounts and any other accounts you manage. Next, review the tax treatment for each item and how a change to your income sources would affect your taxable income. For example, if you were to move money from a taxable account to a tax-deferred account. Afterwards, determine whether you should consider adjusting your asset allocation to move assets into tax-deferred accounts or maximize contributions to reduce your reportable income. Asset allocation is an approach to help manage investment risk. Asset allocation does not guarantee against investment loss. Also, find out the distribution rules for your retirement assets. In most circumstances, you must begin taking required minimum distributions from your 401k plan, your traditional IRA, or other employer-sponsored retirement plans in the year that you turn 73 or 75, just depending on when you were born. And withdrawals are then taxed as ordinary income. And remember, if they're taken before age 59 and a half, they can be subject to a 10% federal income tax penalty. But also create a strategy to minimize taxes now, especially if you fall into the highest or those higher tax brackets, and determine when you will pass assets to your heirs. We understand if some of this information seems confusing or complex, making an informed choice to your distributions, though, is critical, and it's another reason why you should consult with a financial professional and a tax pro. Now, on to our next and another very important point, asset location. All right, asset location, not to be confused with asset allocation, as we mentioned previously, but asset location attempts to manage your tax liabilities by taking advantage of the different tax treatments that some investments offer. And using this approach, some investors strive to maximize their after-tax returns by strategically determining which securities to hold in tax-deferred accounts and which to hold in taxable accounts. So how do you know what's best for your assets? Well, a sound strategy depends on several factors, including your age, your time horizon, and risk tolerance. And if you'd like to explore asset location to see if it's an appropriate strategy for you, again, we strongly advise you to consult with your financial professional and a tax professional to discuss your opportunities. We'll talk about getting the most out of annual gift tax exclusions, which can also be a very powerful estate tool. Gift tax exclusion allows you to give $19,000 to anyone in 2025 without using your lifetime gift exemption amount, as long as you limit the gift each year to that year's exclusion amount. And the IRS won't require the giver to file a tax return. No gift taxes will then be due. So the $19,000 exemption is indexed for inflation and granted separately to each recipient. So here's an example. A couple has three children, and the two parents could give a total of $114,000 to their children. That's $19,000 to each child by each parent. Again, this would not apply to the lifetime exemption, and recipients of gifts don't have to pay gift taxes. Donors are responsible for these taxes. Simplest way to use the annual exclusion is to give cash or other assets to as many people as you want each year. Even if you give more, you still won't have to pay federal taxes, at least until you reach the lifetime gift exclusion of $13.99 million in 2025. You may give more money to individuals by making direct payments to certain qualified medical, dental, and tuition expenses, but these payments won't count against your annual or lifetime gift exclusion. All right, we're nearing the end of our points. We have just a few left, and let's move on to highlight Treasury securities and tax-exempt municipals. And we could talk a lot about Treasury securities, but for the sake of time, we'll only discuss a few important points. Treasuries typically offer interest rates lower than other taxable fixed income investments. Many investors choose treasuries, though, because they're backed by the full faith and credit of the U.S. government. And as a low risk investment, treasury securities can play a role in a diversified portfolio. The government guarantees timely payment of the principal and the interest on the treasury bonds and bills. And if held to maturity, they offer a fixed return rate and fixed principal value. However, the value of the bond is not guaranteed and will fluctuate. Treasuries can also provide some tax benefits. First off, the interest on treasuries may be exempt from state and local income taxes. So for high income taxpayers who live in states with high income tax, investing in treasury bills, bonds, and notes has potential for tax savings. However, you must remember that treasuries may be subject to capital gains taxes. And if you sell a treasury at a gain, you may have a taxable gain. As we mentioned before, the information in this material is not intended as tax or legal advice, and we still encourage people to consult legal or tax professionals for specific information regarding their individual situations. Also, municipal bonds may be helpful for creating tax-free income. When you buy municipal bonds, you're essentially lending money to local, county, state, or other government agencies. And these government entities promise to pay you interest and return your principal by a certain date. And governments use bond money for the construction of schools, roads, hospitals, and other types of public projects. And defaults on municipal bonds are rare. Of the thousands and thousands out there, only 115 Moody's rated municipal issuers defaulted on bonded debt between 1970 and 2022. So, of thousands and thousands of bonds that were issued that were rated by Moody's over a 52-year period, only 115 defaulted. And municipal bonds generate income that may be exempt from federal taxes and, in many cases, state and local income taxes as well. However, not all municipal bonds offer income exemptions from federal and state taxes. And keep in mind that muni bonds are subject to availability, price, and market and interest rate risk if sold prior to maturity. And bond values will decline as interest rates rise. And interest income might be subject to the alternative minimum tax. And if sold prior to maturity, capital gains tax can also apply here. But municipal bonds are also subject to a variety of risks, including the interest rate adjustments, call risk, market conditions, and default risk. But if a bondholder purchases shares of a municipal bond fund that invests in bonds issued by other states, the bondholder may have to pay income taxes. All right, and on to our final point, which is giving to charity. And why we leave this topic for last? Well, we wanted to focus first on helping to ensure that your financial house is in order before examining how you can support the causes that you care about. Ultimately, this is one of our primary goals at Alliant Retirement and Investment Services, and that's to help our clients build financial lives that reflect their values. And we'd be remiss if we didn't mention that. And thanks to certain tax considerations, giving in the proper manner may be able to provide you, the taxpayer, with worthwhile tax deductions. Hope you feel that you've benefited from today's presentation and gained some insights and valuable perspectives on your tax circumstances. I understand that all this tax information may seem complex. Fitting so many new details into your financial vision can sometimes make the horizon less clear. Just think, we haven't even discussed inflation, longevity, risk tolerance, the emotional cycles of investing, and other related factors. But that's where we come in. As registered financial professionals, our job at Alliant Retirement Investment Services is to help you cut through the clutter and find a path forward. And that way you have the ability to build a portfolio that aligns with your goals and values, even as tax laws and markets change. Here we can help you in four key areas: analyzing your needs and goals, helping you select suitable investments, setting realistic performance expectations, and monitoring your portfolio and recommending changes over time. So, to circle back to this slide on the services we offer at Alliant Retirement Investment Services, we're here to help you with your retirement planning, with your IRAs, Roth IRA conversions, consolidating your 401ks, finding out how to be properly invested, and making sure you're taking an appropriate approach to asset location. Life events will happen, and sometimes that calls for amending your financial plan and your financial strategy. We're here to help. And of course, with generational planning, we've mentioned a few reasons earlier as to how we can help you with that, whether it be giving a legacy or helping a charity. We're here to assist in any way possible. And again, I'd like to say thank you to everyone for joining us today. Here's my contact information. Feel free to take a photo of this slide or to scan the QR code. My direct phone number is here, as well as my email address. So if you have any personal questions, ones that need to be delved into more, feel free to contact me with any of those questions.